Hello there everyone, in today's video we're going to take a look at buying a buy-to-let property and whether you should own it in your individual name or jointly with your spouse, or if you should own it in a limited company. So, what are the pros and cons of both of those? Well, let's dive straight in. First of all, having a look at the company. So if you've got your buy-to-let property or properties in a limited company, you're going to pay corporation tax on those profits. And the corporation tax will be at 19%. If the profits are less than £50,000 a year, then it jumps up. It jumps up to 25% on profits more than £250,000. And the bit in between is the marginal rate, which is actually 26%. So there is an increase in corporation tax if your rental profits are more than 50 grand. That's the first thing to consider. Second one, extra SDLT. So when you buy property in a limited company, there is a 3% surcharge above the rates of SDLT to apply that if you are just an individual. So there's an extra cost for SDLT purposes of having your property in a limited company. What else? Admin expense. Extra admin costs of things like bookkeeping, accountancy fees. You have to have company statutory accounts. They have to be filed at company's house every year. Corporation tax computation, corporation tax return. The admin of having a business through a company as opposed to a sole trader, individual, or jointly with a spouse is a lot more onerous. But at the end of the day, that's what you are paying your accountants, your tax advisors for, but it does cost more than being an individual. What else? So, shareholders. With a company, you have different shareholders. You can have family members. There's different ways of getting the profits post-corporation tax out of your limited company. It's quite flexible in terms of how you get paid. Of course, you may not choose to pull out the post-corporation tax profits because you might want to leave it in to reinvest to grow your property portfolio. So there are quite a few things you can do with the shareholders and with the types of shares that you have, both from an income tax play in terms of getting money out and also inheritance tax, mitigating inheritance tax, and what do you do with the capital appreciation on those shares. So no interest restriction. And of course, in the last 5 years, interest relief on mortgages has been seriously curtailed for individuals, but for limited companies, no such restriction. So you're going to get full tax relief on the interest element of mortgage repayments if you have a limited company. Portfolio growth. Well, like I've just mentioned, you don't have to strip out your post-corporation tax profits as dividends. You could leave it in and reintroduce it into the business to help fund the portfolio growth. So, corporation tax relief on things like pensions. So, you've got to have corporation tax on your profit. What can you do to get that corporation tax down? Well, basically you could increase expenses, but one of the things that you would want to increase as an expense is a pension contribution going from your property company into your pension pot. That can reduce your corporation tax bill significantly. So let's have a look at individual ownership. Individual ownership for buy-to-lets, or if you're jointly owned with a spouse or someone else, then taxed on what we call an arising basis at your rate of tax. So if you are a higher rate taxpayer, that's 40% you're going to pay on your rental profits, or 45% if you're additional rate taxpayer. So we're going to do a bit of compare and contrast now. Compare that to 19% if you have a limited company. So the company tax rates, even though corporation tax has gone up this year from 19 to 25% in certain circumstances, it's still lower than the higher rate of income tax. Okay? What else on here? So, less formalities. So, like I said, if you are individual or a couple of individuals owning a property, you just would put the rental profits on your tax return and declare the profit on there. You haven't got the same sorts of formality or the fees associated with doing property limited company accounts or corporation tax return, so it's a bit cheaper from an admin point of view. Interest restriction, so that's the main one. Like I said, with the company, no such restriction. With individual, you've got that restriction. So it doesn't come off as a tax deductible expense, but rather in certain circumstances, you do get credit against your tax bill for some of the interest, but you'll never get more than 20%, even if you're a 45% taxpayer. So interest often will be one of the biggest expenses, certainly the mortgage repayment will be, for landlords. So that interest component, quite large, particularly if you've got an interest-only mortgage, it is the whole of the mortgage repayment. So not having tax relief or full tax relief on interest payment is very significant if you own the property as an individual. So what else have we got? Income from properties is not deemed to be earned income for the sake of pension contributions. So you can't offset your income tax bill by paying into a pension if you own the property in your single name or joint name, like you can do with when it's owned by a limited company and you're paying into a pension pot from the limited company. Company can get tax relief on the pensions, individuals can't. Now, if they've got other income going on, yes, maybe, but in terms of just purely looking at the profit stream from the buy-to-let portfolio, then they can't get tax relief for putting into a pension. So you've got to weigh all these things up, and I would suggest that if you have got one property, for example, and you're just thinking about having just one property, then it's probably not the end of the world to have it in a sole trader capacity or own it 50-50 with your partner or spouse. If you're embarking on what will be a series of property acquisitions and you're looking to over time grow a portfolio, absolutely go with a limited company. That is the way to go because of the lower rates of tax on the profit and the flexibility of getting the money out, and there is no restriction on the interest, and on top of that you get the corporation tax relief on the expenses like the pension contributions. So the rule of thumb I would suggest, if you're getting into the property game for the first time and you just want to get a single property, don't bother with all the limited company setup, but anything more than one, give serious thought getting a limited company set up and running it through that vehicle. So just an overview there on the choice available if you're starting out getting into the property world and how to acquire properties. Now, if you already are a landlord with a portfolio, if you've got several in your individual name or joint names and you are looking to move it all into a limited company, I've done separate videos on that and there's all sorts of things you've got to watch out for. But if you're starting from scratch, basically as a rule of thumb, single property, just probably have it held in your name, more than one, limited company. And do get in touch with me and I will tell you more about it and how I can help with that. So hopefully you like this video. If you do, please do remember to subscribe. And as always, I'll see you soon.